Welcome. Today, we're diving deep into a question that sounds simple, but is actually one of the biggest mysteries in economics. Where does money really come from? Specifically, when a bank gives you a loan, where do they get that cash? We're going to find out what's truly going on behind the scenes.
I mean, really think about it. You go to a bank for a mortgage, and suddenly hundreds of thousands of dollars appear in your account. But where did it come from? Did they pull it out of a giant vault? Did they take it from someone else's savings account? Or is something else happening? This is the core puzzle we're going to solve today.
So to get to the bottom of this, we're going to play detective. We're going to investigate the three main theories about how banking works. We'll look at what each one says, and then, and this is the important part, we'll look at the hard evidence to see which one actually holds up in the real world.
You know, for the longest time, if you asked an economist this question, you would almost always get one of two standard answers. These are the theories that fill up the textbooks and pretty much shape how governments and regulators think about the entire financial system.
Okay, theory number one. This is the one that probably feels the most intuitive. It's called financial intermediation. The idea here is that a bank is just a simple middleman, kind of like a money warehouse. You deposit your savings, the bank holds onto it, and then it lends that same money to someone else who needs a loan. Simple, right? In this version, banks just move existing money around, they don't create anything new.
Now, the second textbook theory gets a little more complex. It's called fractional reserve banking. It starts off by agreeing that a single individual bank is just an intermediary. But, and here's the twist, it claims that the entire system of banks, all working together, can actually create new money through this magical-sounding thing called the money multiplier.
So, let's just put these two side by side real quick. The first theory, intermediation, says banks just move money that's already there. The second, fractional reserve, says the banking system as a whole actually multiplies that money. The huge difference is that in theory number two, new money is created, but only by all the banks acting together in a chain reaction, not by any single bank on its own.
So how is this money multiplier thing even supposed to work? Well, the classic textbook example describes it as a chain reaction that gets kicked off by a brand new deposit. Check this out. Let's say you deposit $1,000 into Bank 1. The bank is required to keep a fraction of that, in this case 20%, or $200, as a reserve. It then lends out the other $800. Now, the person who borrows that $800 eventually spends it, and it gets deposited into Bank 2. Bank 2 does the same thing. It keeps 20% of that $800 and lends out the rest, and this chain just keeps on going.
As this process repeats over and over again, with each loan getting a little smaller, that initial $1,000 is multiplied all the way through the system. And with a 20% reserve ratio, that single $1,000 deposit can eventually support $5,000 of total money in the economy. It seems like a pretty clever explanation, right?
But, and this is a really big but, what if both of these mainstream textbook theories are just wrong? What if there's a third theory out there? One that was actually pretty common about 100 years ago, but has been almost completely forgotten since.
This is the credit creation theory, and it makes a claim that sounds, well, kind of crazy at first. It says that banks are not intermediaries at all. It claims that every single time a bank makes a loan, it doesn't lend you someone else's money. Instead, it creates brand new money literally out of thin air, just by typing numbers into your bank account.
And believe it or not, this isn't some wacky new idea. The economist Henry McLeod was writing about this way back in 1856. He said the real business of banking isn't lending money, but creating credit. Capital created out of nothing. So for a long time, this was actually how people thought it worked.
So, let's recap. We have three totally different explanations. One says banks are just middlemen. The second says the system of banks creates money. And the third, this forgotten theory, says each individual bank creates money from scratch. So how on earth do we figure out which one is actually true? We need a decisive test. We need to see it with our own eyes.
And that is exactly what an economist named Richard Werner did. In a brilliant and simple experiment, he got a German bank to cooperate with them. They let him watch their internal accounting system at the exact moment they issued a real 200,000 euro loan. This was it. This real-world test would finally settle the debate once and for all.
All right, so here's a snapshot of the bank's balance sheet right before the loan was made. You've got assets on one side, that's money other people owe the bank, and liabilities on the other, that's money the bank owes its customers, like their deposits. The key thing here is that the two sides are perfectly balanced.
And now, here's the balance sheet the instant after the loan was created. Boom! Look what happened. The bank's assets went up by exactly 200,000 euros. And at the exact same moment, its liabilities, the new deposit in the borrower's account, also went up by 200,000 euros. No money was moved from anywhere else. The bank's balance sheet simply expanded on both sides. This was the smoking gun. The proof. New money was created, right there, by a single bank. The credit creation theory was right all along.
So, okay, the evidence is in. But you might be thinking, so what? Why does this accounting detail matter? Well, it matters because it changes pretty much everything. The fact that private banks can create money has massive, real-world consequences that force us to rethink how our entire economy works.
I mean, this one fact completely upends our fundamental ideas about how to regulate banks, what really causes financial crises and asset bubbles, and even the basic advice we give to developing countries about economic growth. It goes right to the heart of what money even is.
If you want to see just how crazy this can get, just look at this story from the 2008 financial crisis. The bank Credit Suisse needed to raise capital to avoid a bailout. So what did they do? They created £7 billion out of thin air and lent it to investors. Those investors then immediately used that brand new money to buy shares in Credit Suisse. In effect, the bank just printed the money it needed to save itself.
And that right there is the core of the problem. For decades, the main tool we've used to keep the banking system safe is something called capital requirements, which are all based on the old, wrong theories. But if banks can just create their own capital, like Credit Suisse did, then that whole regulatory framework is basically built on a foundation of sand.
As Martin Wolf, the chief economics commentator for the Financial Times, put it so perfectly, our money supply isn't carefully controlled by some central authority. For the most part, it's created by banks as a byproduct of often irresponsible lending. And that's what fuels the crazy boom and bust cycles that can do so much damage.
Which leaves us with this one final really profound question. The power to create money is easily one of the most important powers in any society. So if the evidence shows that this power now rests with thousands of private profit-seeking banks, who do you think should really be in control of it?